thought, okay, maybe my friends and I can buy some small buildings in Brooklyn or something. It felt like you had to know somebody in order to get into a real estate deal. These individual deals are kind of back room happening at country clubs, not a lot of information available. EquityMultiple was born on the idea that the internet could move this old business online. Investors can invest in the equity, but we also offer debt. We have 84 investments that we've exited to date. Our average realized return to investors is 17%.
Welcome to Value Add, your edge in building wealth. Today we have Charles, CEO of EquityMultiple. We're here to talk about real estate investing. Hey Charles, how are you?
I'm great. Thanks for having me on.
Thanks for joining. You've been running EquityMultiple for, I believe, about 8 years now. Could you tell us a little bit about what got you to start EquityMultiple and how you got to this point of I want to start a crowdfunding platform for commercial real estate?
Yeah, absolutely. I mean, so going way back, I did not grow up in a family of investors. I didn't grow up in a family of people in business. So I came to it through a long road, I'd say. I went to law school. Started to gravitate more towards the business side there. Started to learn a little bit about real estate, but it wasn't really until I landed at a law firm called Simpson Thacher in New York that I got my first true exposure to kind of the world of big private equity and real estate investing. So my clients were basically the biggest private equity companies, Blackstone, KKR, Carlyle. Working on the legal side and working on the deal side are definitely different things, but I started to get familiar with that universe. When I started to have some money and think about investing on my end, real estate was a really natural place for me to look. I started to look around the market, and really the options are public REITs, which as we see now, they kind of trade up and down with the market, regardless of the underlying real estate fundamentals. And then private REITs, which I think some are better than others, but particularly at that time are just so overloaded with fees. There's a lot of other people making money in that value chain other than the investor. Looking around at kind of the options for direct investors, it felt like you had to know somebody in order to get into a real estate deal. So I thought, okay, maybe my friends and I can buy some small buildings in Brooklyn or something ourselves. I was working in Manhattan, so we would go in on the weekends and tour these beat down properties in deep Brooklyn. Frankly, we just didn't have the time or the on the ground expertise to do all of that ourselves. And just felt like there had to be a better way. Around that time, I started to get familiar with the passage of the Jobs Act. And as a lawyer, passages of new acts are more exciting than they are to normal people. That really basically allowed for investment businesses to get online and start talking about investments the way that other kind of digital businesses do. From where I was sitting, when laws change like that, it can just be transformative to how money moves in the economy. So I think it was a combination of seeing this hole in the market, this thing investors clearly want. Investors want real estate. They always have. This new method of that connecting to the customer, kind of shedding light on an industry that had been really opaque. These individual deals are kind of back room happening at country clubs, not a lot of information available. I think as many of those have bad actors in them as don't, just because it's not transparent, right? So EquityMultiple was born on the idea that the internet could move this old business online, bring the visibility that the internet does, bring some of the same kind of institutional processes that you have at a big asset manager to this world of more middle market commercial real estate investing.
That's awesome. I want to touch on one of the things you mentioned, which was REITs, at least in the last year, tend to follow public markets. It's interesting that the last 15 years, we've had a situation where we had low interest rates, no inflation. And if you think about millennials, a lot of them weren't investors until late of last decade, right? We entered the public markets, and very quickly we realized 2022 that when shit hits the fan, all correlations kind of lead in the same direction, especially in public markets.
100%.
So I'm assuming EquityMultiple is providing access to private market investments, right?
Yeah. So it's direct real estate investments. It's also various types of diversified real estate investment vehicles. So our bread and butter has definitely been invest in a individual property. That could be multifamily, industrial. Those are the ones we've focused on the most because they've really had the strongest short and long-term fundamentals. But we've also done projects in hospitality, hotels, even more idiosyncratic stuff, car washes, a little bit of retail, a little bit of office, not so much these days given the outlook for office, kind of playing across the major food groups of commercial real estate. Then importantly, we're not just investing in the equity, right? So investors can invest in the equity, they can be kind of the owners, but we also offer real estate debt. So if you want to be more on the lending side, more of a fixed income, current income, kind of a different risk proposition, we offer that as well. What we try to do is adapt what we have at any given time based on the market conditions. So as I said today, given the future of office, very gun shy on offering any kind of office. Right now, we're pushing heavily into real estate debt because I think the opportunity there with rates going through the roof is tremendous. We're launching a real estate debt fund, so we'll have individual loans that investors can invest in, but if they want to diversify in one investment, they can do that through a fund. Really, we don't offer as much volume as some of our competitors do in terms of just number of investment opportunities, but we try to offer real diversification in terms of what we do offer.
Got it. And you mentioned the Jobs Act. So does EquityMultiple provide access to accredited and non-accredited investors? Are you under Regulation A, Regulation D? What kind of access do you provide?
So today we operate just under Reg D, so just available to accredited investors. We are looking at launching a second fund later this year, an equity fund. We think that the buying opportunity in real estate equity is going to be very good, especially as you get later into this year. I think we're looking at doing that as a Reg A vehicle so that we can offer it to non-accredited as well as accredited.
Interesting. So if I were to invest through EquityMultiple, what are minimum investment amounts and what's the whole period? When can I expect to see some kind of return? On average, based on the last 8 years, what returns have you actually seen versus projected?
All great questions. So in terms of minimum investments and in terms of the duration of investment, that stuff varies pretty significantly. On the low end, $5,000. On the high end, we try to keep it as low as we can so people can diversify. But I would say sometimes we push as high as 25 or 30, depending on how many investors we're allowed to bring into the investment. On the duration, we have a diversified note product that's the duration is as short as 3 months. And on the long end, we have sort of the 5 to 7 year range tends to be where we top out. Occasionally, we'll offer a fund that has a longer duration.
Interesting. I was looking at your products. You have something called Keep, which you portray as synonymous to a savings account or the savings interest rate. And then you have a short term and then a long term. So that's the 3 months to 7 years, I guess.
Basically, we think about our buckets as this short-term note, which is sort of your like CD, just put it in 3 to 6 months or maybe 9 months. Earn, which is going to be that middle duration, maybe 1 to 3 years. That's focused on income. That's going to have a current dividend. And then Grow, which is going to be anywhere from 3 years on. And that is some combination of current dividend and capital appreciation, depending on the nature of the project. Some equity projects have dividends right away. Some development project doesn't have really any distributions until it's sold. I skipped over your question on just overall returns. So we have 84 investments that we've exited to date. Our average return to investors is 17%, so annualized.
Wow, that's a great return. So how many deals have you had overall? And where I'm going with that question is, that's a lot of deals. So I'm assuming on average you're doing somewhere from like 10 to 15 deals a year. What is your typical due diligence process? How do you get your investors comfortable with the investments that you're providing them?
So in total, I think our current portfolio is around deals that we're asset managing now is around 100. So somewhere in that ballpark of 180 total deals we've done since inception. Our diligence process really looks like a private equity style due diligence process. Everyone on our real estate team is people who worked in real estate, private equity or at public real estate companies, comes from the world of professionalized investors, and they're doing a screening process on the sponsor themselves, of course, but also on the underlying deal. So taking the pro forma, putting in different assumptions, calling brokers to confirm if the assumptions make sense, going down and touring the building, looking at the environmental report, the property condition report. Typically, we also take control kind of rights in our deals. So unlike some of the competitors in the space, we're not a direct to sponsor model. You're not investing directly with the sponsor. You're really investing with us, and we're investing all together with all the investors with the sponsor. We kind of take the collective bargaining power of all these small investors investing together and use that to command some oversight of the sponsor. It's obviously checking up front on them and their background is always the first step, but having the ability to influence how things go, how decisions are made is something we feel is valuable. And we have a separate asset management team that is responsible just for that kind of like monitoring and helping to deal with anything that comes up.
Regarding your sponsors, why do sponsors want to work with EquityMultiple versus raising cash elsewhere? The reason I'm also kind of asking this question is I think one of the criticisms of crowdfunding platforms is sponsors who can't raise money elsewhere will maybe go to crowdfunding platforms or the likes to raise capital because it's easier than raising elsewhere. So if they couldn't raise capital elsewhere, which in my mind would reflect that maybe their deals aren't as good, though your returns sound phenomenal, why do sponsors want to work with you?
That's a great question. In the industry, we call this the adverse selection issue, right? Is how do you avoid getting the worst slice of deals? I think when we started and the dollars we were raising were very small and there was no certainty that they would be there, you were not having your pick of the litter of who wanted to work with you, and you were working very hard to get into transactions that you could just be a little piece of, and they had most of their money raised elsewhere. But that dynamic has shifted quite a bit over time. I think you've seen the adoption really across the value chain with wanting retail investors to participate. So I think you've even seen sponsors as big as Starwood Capital, which has the second largest non-traded REIT, use this channel. I think that even in that case, if you have a big sponsor who uses institutional investors, why are they using crowdfunding here? So our thinking on that is actually that us chasing the institutional sponsors trying to be a replacement for private equity capital. Because I agree with you, I think it's hard to understand why they're choosing you instead of a private equity check. Where we focus is what we call the middle market. Deals below $40 or $50 million total, which is really below the threshold of where institutional capital invests. Because for them, the check size is just too small. They want to do larger transactions. So in that space, the way that people generally raise money is really inefficient. They're raising it from friends and family. They're raising it from family offices. They're raising it from literally like the country club. And that's a really time-consuming process for them, even the ones who are good at it and have great performance. And it doesn't scale that well, right? Because if you want to go faster, if you want to build your business, it's hard to keep expanding those capital relationships. You can't keep going back to the same people over and over again. So we've really set up our business to offer something doesn't exist that much in the capital market because there's not a lot of institutional capital. From the sponsor's perspective, we don't really operate as a crowdfunding site. We operate as an investor. So if someone says we need $3 million, we underwrite them, we underwrite the transaction, we issue them a term sheet, we say this is what we're going to need if we're going to invest, and we say we'll give you $3 million. It's on us to go get it. So we will even backstop that money will be there so that our money's the same as an institutional investor. We're not saying, oh, maybe $3 million will be there. We're saying $3 million will be there, and then it's how we get it is up to us. I think by making ourselves look like a more traditional capital source, we've really helped to avoid that adverse selection problem, which is, I think, a really astute thing to hit on.
Interesting. So you mentioned 84 deals closed, 180 deals in total. Good number, great returns. How many investors have you had, and what is your typical investor profile?
Yeah, so we have around 40,000 people signed up for our platform. About 10% of those are active investors. On average, active investors invest with us 5 times. So a lot of that kind of good repeat behavior, which we think is a good indicator that people are generally happy with the experience they've had with us. Average investment size, I think, is in the range of $25,000. But there's a big spread in that, obviously, between people who invest bigger checks and people who invest smaller. Average kind of career profile, demographics. I think our average age is around 44. You're looking at people basically in their 30s, 40s, 50s, and 60s. A lot of people who are kind of high income earning professionals, but that could be any profession, right? You have people in tech, you have people who are doctors, you have people who are attorneys in finance, in real estate. Then you have a few folks who are kind of more in the mini family office, managing, do a lot of private investing, that sort of thing. But The core customer is really people who are looking to diversify, who don't have a lot of alternative exposure, who are moving beyond stocks and bonds.
Got it. How do they find Equity Multiple? Is it a lot of word of mouth? Is it your advertising?
Look, it's both. We have a referral program for our existing customers. We do things like this, do podcasts, speak to the people who are speaking to investors, right? Talk to the people who are trusted voices in our kind of industry of direct investing and try to get the word out. We also do advertising, digital marketing to try to spread the word. It's a multi-channel kind of approach. We're not like a big venture capital kind of funded business. We have raised money into the business before, but trying to build something that grows organically with a little bit of push behind it, build something sustainable.
So are you backed by angel investors, or do you have like some small VC check? Is that what you mean? Or is it fully bootstrapped?
No, we were bootstrapped at the beginning, predominantly, I guess what you would call angel investors. Our largest single investor is a family office of a guy named Ken Pasternak, who was a founder of a company called Night Trading. Really interesting business. If you're outside of finance, you may not remember it, but they were the first electronic market maker in the stock market. Yeah. Trades all used to happen with pencil and paper, and then all of a sudden they didn't. That was his business. They had 80% market share in like 3 years, something crazy like that. So real founder, incredible business mind. He's now runs a real estate fund, so he's been a great backer of ours. Outside of that, folks kind of in real estate and finance and tech have been the kind of predominant group. I'm trying to find folks who can add value to the business, not just through money, but also through advice, connections, that kind of thing. Then recently, we added John Stein, the founder of Betterment, as one of our advisors. I think that they are, of course, on the stocks and bonds side, but I think we're all kind of this same ecosystem of trying to manage your money more.
That makes a lot of sense. Who would you consider to be your competitors, and what in your mind is Equity Multiple's competitive advantage?
I think the biggest competitor in real estate crowdfunding is CrowdStreet. They've raised the most dollars, and I think we have quite a differentiated business model from them. They really operate more as a marketplace. I think they do some sponsor vetting up front, but really you're going into the sponsor vehicle. They're a broker, they're making broker fees. We're really trying to be more of an asset manager. So we're staying in these investments from beginning to end. Oftentimes we'll have some form of success-based compensation that aligns our interests with the investor. We have that separate kind of asset management team. When times are good, you don't really notice the difference between these models. But over time, I think it's been proven in the real estate industry and that this sort of centralization and having kind of an active role is a really positive thing.
That makes a lot of sense. One last question I have before we switch gears. So you spoke a little bit about fees of CrowdStreet. How does Equity Multiple make money?
Yeah. So we make an upfront fee from the transaction itself. Basically, it depends on the type of investments. For a loan, the borrower pays an origination fee. For some of the equity investments, we'll have an administrative technology fee that's on the front end, not paid by the investor, paid by the transaction itself. Then we have a 1% annual asset management fee that is charged to the investor. That's really for that work of monitoring, reporting, doing kind of that ongoing piece. And then in some cases, in equity transactions, we'll have a share of the sponsor's carried interest. So if they do well, the investment outperforms, then they'll get a larger share of profits and we'll take a split of their profits.
Does Equity Multiple have any kind of skin in the game, or is it more just providing the access, underwriting, great sponsors, great deals?
At this stage, the answer is no. I mean, for one of our products, the Alpine Note, we do co-invest in that, and we co-invest actually in a junior position. So basically, we would lose all of our money before investors lose any of theirs. I think people on our team have co-invested in specific deals at various points over time. It's definitely on our radar. It's easier to do in one vehicle like a fund than do across a huge range of investments just from a balance sheet capital management perspective. We definitely appreciate the alignment that creates. We do our best to align ourselves in other ways, but we're only doing that on select investment products right now.
I want to switch gears a little to talk about the market. What have you seen in terms of how the market has changed? Because you've gone through 5 years of, I don't even know what to call it, whether it's normalcy or not. And COVID, crazy market, leading into high inflation, leading into high interest rates. Now we're here. today, where interest rates are still increasing, people are talking about a recession on the horizon. Some people say that SVB might be a catalyst into that recession. How have you seen that market been, and how have you seen that change?
Yeah, after a incredible bull run, the last few years have been very strange and bumpy, right? I mean, there's no doubt about it. The catalyst is COVID, even for what we're dealing with today. It's a little more indirect, but really this is all kind of COVID cascade. COVID was an interesting time for the markets because in the public markets, you saw just straight panic followed by that rapid recovery. In the private markets in real estate, there wasn't as much straight panic because there was this feeling of, okay, we can maybe hold our breath a little bit here and wait till we're on the other side, right? This feels temporary. So certain sectors were hit extremely hard, extremely quickly, and they bounced back at different rates. I think hospitality, no one was staying at hotels for a while. So that really cratered. But then certain parts of that came back with a vengeance. Now there's hotels that are outperforming where they were a few years ago. Senior care facilities, right? They were hit tremendously hard and it was harder for them to bounce back. But most sectors kind of came out of that pretty well and quickly, even on fire in the case of, say, multifamily. And then for the real estate industry in particular, 2022, really coming off of a banner year in 2022 for most types of properties, was a total disruption, more disruptive than COVID, because interest rates have such a direct relationship to real estate property values. It doesn't happen overnight, but at the end of the day, just like your home, if it costs you more to borrow, it should cost you less to buy because that cost to own it goes up. So when rates go up as quickly as they did, really at an unprecedented pace, it just disrupts the market. People don't want to transact. People don't know what the value of anything is anymore. That was really the story of 2022. We had a banner year in 2021, doubled our transaction volume, doubled our revenues, and the beginning of 2022 also very strong. And then as that interest rate spike started to happen, we really pulled back and did less transaction volume. It's just harder to find things that made sense still because you didn't quite know where the new rules of the road were. I think as we're turning the corner here in 2023, I think Silicon Valley Bank was a very stressful weekend for those of us who follow that kind of stuff closely. I think that the action of the Fed to step in to backstop depositors certainly helped shore up what could have been a rapidly problematic situation. In a way, I think that it forces the Fed's hand to, moderate on interest rates, because interest rates were a direct catalyst in Silicon Valley Bank and the other banks falling. As you start to see, maybe you don't know exactly where rates land, but you see that they are starting to crest. That starts to bring transaction volume into the market again. Transaction volume at lower prices than there existed a year ago, and in some cases substantially lower. I think the buying opportunity that 2022 rate changes is going to produce in 2023 is likely a once in a cycle thing. Right now, we're also really focused, as I said, on real estate debt, because I think that where exactly interest rates shake out, is this the best possible price you can get? That matters a little less on the lending side. The flip side of rates increasing for equity values is that it means that your rate of lending has gone up dramatically. So a real estate loan that might have been 7% a year ago is now 12%. So that makes it a very attractive proposition for investors. We're being really selective on the equity side right now, finding things that really make sense at this exact moment, then offering more lending opportunities. That's how we're kind of seeing the market. I think the place where you're seeing the most stress is in office, because just the fundamentals feel different there now. It's certainly different from city to city, but in New York, you just have office usage that's not recovering and may not recover. So there's parts of the market where office is still strong and in demand, but there's also buildings that look like they're never going to command the same rental value that they did a few years ago. So I think that's an area where we have this underlying issue of what is the demand here for people to rent this, combined with rising interest rates. And you've seen a lot of really notable landlords say to the lenders, you can have the keys. We can't make this work. So I think that's the area where you've seen the most stress in the market. In terms of interest rate protections, right? So a lot of the times, and this is getting really in the weeds, you can actually buy in advance a cap on your interest rate. So you can purchase upfront a protection against interest rates going up like this. So certainly for transactions where people started to talk about interest rates moving, people started to buy those. We started asking sponsors to buy them so that if things did spike, they couldn't spike 5%, they could only spike 2%. So you could have some control of your variable costs, but you just can't have things, people can't see the future. And you can't have conditions change this much, this quickly without impacting decisions that were made in 2018, 19, 20, whatever the case, when the world looked different.
I want to switch gears again a little bit and maybe just talk a bit about your startup journey.
The experience is incredibly, incredibly different, particularly at working at a big corporate law firm. There were 1,000 lawyers in my office, and just as structured of an experience as possible. And the biggest thing about starting a new business is that there's no structure, right? You have to build all the structure. I think that the notorious hard work of corporate law certainly prepared me for what you need to do to make a startup successful, especially as you're scrapping through in those early days and trying to figure out what is this business? How do we make it? How do we deliver something that's valuable to your customer? I think it sounds maybe like a trite to say, but it's an incredible people-driven thing, right? Every person who joins can make a big difference in your business and how it grows. I feel really honored by the people who have joined the team and the way we've grown, and the way we've been able to bring on experts, folks who were in the real estate industry long before I was, who are now part of this team and helping to kind of build our internal capacity. I would say if I had known everything that would be involved when I started, would I have done it again? I don't know, but here we are, and I'm happy we're here.
Taking risks is more fun than not.
100%. Well, that was the piece about me that I knew was not going to last in corporate law. I like risk a little bit.
What was the biggest challenge that you faced building EquityMultiple?
I think, candidly, it's this last year when things change this quickly, when things that were working are no longer working. How do you adapt? I think especially with investments, you can't change what you're doing overnight, right? You got to make sure you have a thesis. You got to make sure it's set up well. You got to make sure that the opportunities are going to be there. This year, definitely, I would say there's these existential struggles you have when you're young and a young business that are different. But as you get to more scale and those decisions get a little weightier, the amount of adapting we've had to do this year, I think might top the list. Maybe that's just recency bias.
No, I've talked to other founders. I think that's absolutely true. Last question I have. So you've been an investor for a long period of time. If you had any advice to give your 18-year-old self from an investing standpoint, what would that be?
It's a great question. I'd say it's two things. First is just education, right? Understand the world of options out there, because there's obviously a lot of them. Knowledge is kind of the key to power with this stuff. Not to say you have to be an expert in everything that you invest in, but you want to understand kind of what the fundamentals are, and you want to understand what the organizations you're looking at are and how they operate. And then the other is take risk. Let's do it in a diversified way, particularly when you're younger. You should be taking more risk with your investments. I think that's not investment advice. We're an investment advisor, so I can't say anything that could be investment advice. But the stereotype, of course, is take more risk as you're younger and less as you're older. I personally think that's true. But really spreading things around, particularly as you're climbing the knowledge curve. If you become a deep expert in something, then you should consider going harder there. That's kind of the Warren Buffett style, right? But for most of us who are not professional investors, spreading your bets makes a lot of sense.
I think that's great advice for anyone. Charles, thanks a lot for your time. This was an absolute pleasure. Really appreciate you walking us through your journey. EquityMultiple, check them out. Great product, great returns. Thanks again.
Yeah, no, thank you too. Really appreciate you having me on, and thanks everyone who listens.
And that's today's value add. If you liked today's episode, hit that like and subscribe button. For long-form written content, subscribe to my newsletter. Otherwise, say hello on Twitter. See you there.